Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the first 2023 edition of the MAI Market Update. We'll spend our time today looking back at the challenging market performance in 2022 and looking ahead to the outlook for 2023 and beyond. Well, the markets made up some ground in the fourth quarter, but unfortunately not enough to turn the tide on what was an otherwise dismal year for both stock and bond markets. In their quest to fight inflation, the Fed and other global central banks raised rates aggressively, which led to a widespread repricing of risk across asset classes with few places to hide. As shown in the data on your screen, the US S&P 500 index and the global MSCI All Country World Index finished in about the same place for the year, down right around 18%, the worst performance for equities since the great financial crisis in 2008. Within the equity markets, the biggest story of the year was the drastic outperformance of value stocks versus growth stocks, with value outperforming growth by over 21 percentage points, due in large part to the major valuation compression that occurred across the growth-oriented technology sector, as well as the strong year for the value-oriented energy sector. If equity market returns were once in a decade bad, we would characterize the losses in the bond market as once in a half-century bad, with the Bloomberg Barclays Aggregate Bond Index turning in its worst year on record, dating back to index inception in 1976, with a loss of 13%. This next chart on your screen displays stock and bond market calendar year returns dating back to 1990 and shows just how unusual 2022 was in terms of having such bad performance from both stocks and bonds in the same year. If the inflation shock that occurred over the past 12 months was the catalyst for this phenomenon, which we think it was, it seems unlikely to repeat itself now that inflation appears to have peaked for this cycle and is now on the decline. Looking ahead to 2023, the impact of the Fed's actions to create more restrictive financial conditions is likely to manifest itself in a deteriorating economy and potentially a recession. The Conference Board's Leading Economic Indicators Index has now registered 5 straight months of negative readings, and as shown in the chart on your screen, is on a concerning trajectory typical with historical recessions. In this context, 2023 should see an increase in the unemployment rate from today's benign levels, a further slowdown in housing activity, reduced consumer and business spending, and pressure on corporate earnings. All of this points to a fairly bleak outlook for economic and corporate fundamentals over the next 12 months. With this type of cyclical outlook, it's as important as ever to remember that the economy is not the market. Consider the fact that in 2022, real GDP growth is expected to be up close to 2%, and S&P 500 earnings look to be up around 6%, in a year that market indexes fell close to 20%. Is it possible that 2023 could be the exact opposite of what occurred in 2022, where fundamentals underperform, but markets outperform? We think the answer to this question hinges on the path of inflation, which the Fed has made abundantly clear needs to come down in a sustainable way in order for them to let up on rate hikes. But if we do enter a near-term recession that quells inflation and causes a more accommodative stance from the Federal Reserve, we think that the outlook for beyond 2023 could improve and markets respond favorably. In some respects, a more resilient economy could actually be the worst-case scenario for markets if it means the Fed has to keep raising rates even higher than they currently project in order to tackle a more sustained inflation problem. Regardless of what transpires over the next 12 months, the outlook for long-term investment returns has clearly improved following the valuation reset that occurred in 2022. The closely followed long-term capital market assumptions from JP Morgan recently pegged the 10 to 15-year long-term outlook for a 60% equity, 40% fixed income portfolio at 7.2% annualized, up from 4.3% annualized at the end of 2021 and the highest reading since 2010. While these are obviously just estimates, We agree directionally that the reset in equity valuations and the meaningful increase in bond yields has created an environment that's attractive for new investors and good reason for existing investors to stay the course with their portfolio amidst the current volatility. At MAI, we believe in constructing and managing portfolios in a manner consistent with the long-term goals of each client and sticking with the plan through the ups and downs of market cycles. While we remain hard at work to identify the most attractive risk-adjusted return opportunities in each asset class, we're also aware that the biggest driver of long-term success in investing is having the patience and the resolve to stick with the plan, especially after years like 2022. It's this reality that makes us so grateful for the trust that you've placed in us to take a long-term approach that fosters patience in times like this. As always, we would encourage you to reach out to your wealth advisor at any time to discuss your portfolio in more detail. Thanks so much for listening. And from all of us at MAI, we wish you and your families a happy, healthy, and prosperous 2023.